gonna die, you might as well die rich, right? People panic for no reason. Let's go get some puts. I don't know why it's dropping. I've seen this before many times. SPY, SPY. Alright, it's going down more, so I'm gonna add more. I've got a shitload of SPY contracts. Alright, there we go. Oh, there's pushing down hard now. Alright, Apple's pushing down pretty hard. And here comes SPY, break a new low. Boom, right there. There goes SPY, pushing down more. Wow, Tesla just made a new low. Hold on, that could really set off the market. Wow, oh my gosh, you should see, oh my lord, how much volume is going on right now on the level 2. That's a lot of volume. There's a lot of panic going on right now. Google, Apple, Tesla, Disney, Nvidia, PayPal, all just made new lows. We're at 61%. Okay, ooh, we're having some strong pull-up. There, I'm going to be getting out now. I can start to see both of them coming up at the same time. This could be institutional bottom purchasing. I'm out. I'm all out. So all 30 contracts right there. Woo-hoo!
Daily homework for you guys that are trying to learn how to trade. Alright, so before you can do anything, you have to know how to read a chart. I recommend going and watching this video right now. You can watch all of his videos. Very successful young trader. Yeah, you can't trade unless you know the basics of a chart.
We'll obviously those stock charts with the green and red boxes and lines and numbers going up and down and all over the place and get confused and overwhelmed and think to yourself, I'm gonna be bored forever. Well, let's change that. Give me 1 minute here and we'll teach you to read those for the rest of your life.
So this screen here represents what is known as a candlestick chart. These bars here are candlesticks, and these lines along the bottom represent volume, or how many shares are traded per day. But the most important part are these candlesticks. The top and bottom of the full bar always represent the opening price and the closing price. Since markets technically are only open from 9:30 to 4, the open and close represent the morning and afternoon prices respectively. The lines on the tops and bottoms of the candles, known as wicks or shadows, represent the highest ever price or the lowest ever price of a stock for the day. Green or white candles means the stock went up for the day, because the stock opened lower in the morning and closed higher in the afternoon. Red or black candles are the opposite, meaning the stock lost value because it started higher in the morning and closed lower.
That's how I made 1,200% on one single trade using a simple moving average strategy. First, you want to get on TradingView, type in 3 moving averages, and click this one by Advent Trading. Then you want an exponential moving average, so type in EMA and click this one right here. Now that we have the indicators added, let's change the settings a bit. Click the settings for the triple moving average, change the lengths to the following: 13, 21, and 55. Then I'm also going to change the colors for simplicity's sake. Then I'm going to go to the settings of the exponential moving average and change the length to 8. The strategy is simple. You're going to have 4 lines on your chart: the 8, 13, 21, and 55. You want to buy when the 55, the red line, crosses to the bottom. So right here, for example. You are going to hold until the 55 crosses all the way to the top. So right here, for instance, you would have sold. I should also be clear. If the 55 crosses only one line like this, you do not sell. You only sell if the 55 is all the way on the top.
Now that you know how to actually interpret a single candlestick, you'll see that a bunch of them put together makes up a stock chart. So you'll notice when we start turning down in price, you'll see a lot more red candlesticks. That's because price is decreasing. And then when we go higher, you'll see a lot more green candlesticks. That's because we're increasing. Just because a candlestick is either green or red does not necessarily mean that price will either continue higher or continue lower. Remember that candlesticks represent what buyers and sellers in the market are doing. So let's actually learn how to interpret each candlestick and see who's really winning, the buyers or the sellers. Sometimes you'll get candlesticks that look like this, and they're what's called a doji candle. Even though this candlestick is green, it actually represents a likelihood of price dropping. And even though this candlestick is red, it actually represents a likelihood of price increase. See, we have a very long upper wick. That means that price went up strongly, but then got shot right back down to this closing price, and that's why there's such a big difference. And this candlestick, we see that we sold off strongly, but then the buyers bought it right back up.
A couple $100 a day trading cryptocurrency. But we're in a recession. You can't just buy and hold Bitcoin and make a bunch of money. You actually need skill to trade now. So what do you do? Well, the first step is going to go to tradingview.com, click Crypto Screener, and we're going to see a list of cryptocurrencies. So you're going to find the cryptos that are up the most in the past couple of days to weeks. Just go on the charts and you're going to see a nice uptrend, hopefully. If you're surfing these 10 and 20 day moving averages, then you are in good shape. Next, you want to look for a buy point. Firstly, you're going to want to keep in mind psychological numbers, so whole numbers and half numbers like $1.50 and $2, right? Then if we take a look to the left, we're going to see that we have a clear area where we have seen some bounces in the past, and you can deduce a nice little zone where you can look to buy. We are looking to buy between 14 and 13.50 whole and half numbers. Then you want to drop drop down to a smaller time frame like the hourly time frame, it's better off to wait for a bounce to confirm that that level of support is actually holding. We are seeing a bounce right now. I'm going to be looking to buy this once we get a nice bounce and then a pullback into around $14.50. Then we can target up to around $20, which is the next big level on that daily time frame. That gives me around a 7-to-1 risk to reward, which means that you can literally lose 6 out of 7 trades and still be making money.
This is the one thing that you need to know about chart patterns and technical analysis that pretty much nobody else teaches you. Now, I'm probably going to get a lot of hate on this video, like, oh, technical analysis is BS, or, oh my god, it's like the one thing I use to trade. But this is like the one thing that you really, really need to know. The art of drawing lines on your screen, trying to predict where the price is going to go because of them, is only important because other traders are doing it. It's the collusion between other traders and you seeing the exact same pattern and buying on the same pattern breaks and sell-offs that make these patterns actually work. Special lines drawn on your screen does not move the market. Volume does. But when those lines align up with a lot of other people's viewpoint of where the market is going to go, more volume will rush in or out of the market, and then that is what actually makes the price of something move. If you found this interesting or helpful, please shoot me a follow. I try to post as much valuable content as I can.
3 reversal chart patterns you must know if you want to get better at trading. The first one being head and shoulders. It'll have 3 peaks, where the outside 2 are close in height and the middle one is the highest. You usually enter a short after price goes below the 2 bottom lows. Pretty cool. The next chart pattern is a double top. A double top is an extremely bearish reversal pattern that forms after price reaches a high 2 consecutive times. Lots of traders like entering a short if they start seeing a strong rejection as the second peak is forming. Or you can enter a short once price goes below the recent swing low for a confirmation trade.
Looks easy enough.
The final chart pattern is a double bottom. The double bottom is the opposite of a double top, or you can just think of it as a W.
That's a W.
We can preemptively enter if you start seeing the support hold, or you can enter once price goes above the middle peak for a safer confirmation trade.
So I made almost 900% on a single trade using one simple indicator. First, you're going to want to go on TradingView and type in trend lines with breaks and click on this one by LuxAlgo. Next, we're going to go to the settings menu. Change the length to 24, change the slope to 1.6, and just make sure the slope calculation method is on ATR. The strategy is simple. When price breaks above a blue trend line, we get a buy signal. And when price breaks below a red trend line, we get a sell signal. You can also go to the settings menu again and click on show only confirmed breakouts to make sure it only gives confirmed signals and avoids false breakouts.
When it comes to technical analysis and trading, it's important to understand the market structure. So let's go over some basics. Price action can fluctuate in 3 directions. It can move up when buyers are overpowering sellers. It can move down when sellers are overpowering buyers. And it can continue moving sideways when the strength between buyers and sellers is neutral. Now, price action moves in waves due to the changes between supply and demand, and each wave can be a different size or length depending on the strength between buyers versus sellers. Now, when it comes to trends, there are uptrends and there are downtrends, which are typically composed of impulsive waves followed by corrective waves. Impulsive waves are simply long and volatile movements that go in the direction of the trend, whereas corrective waves are typically shorter counter-trend movements. When the strength of impulsive waves decreases, the trend slows down until it transitions into a period of consolidation.